What you're about to hear is going to sound impossible. It's going to sound like fear-mongering, like clickbait, like another conspiracy theory designed to get you worked up over nothing. But I need you to stay with me, because what's happening right now in the precious metals market isn't theory. It's not speculation. It's documented, verifiable, and accelerating faster than most people realize. The warning isn't coming from me. It's coming from the world's largest financial institutions, central banks, and the very people who control the levers of our monetary system. And they're not just warning anymore. They're acting. They're moving billions of dollars into physical gold and silver at a pace we haven't seen in generations. The question you need to ask yourself is simple. What do they know that you don't? Let me paint you a picture of what's unfolding. Gold has been climbing steadily, breaking through resistance levels that analysts said were impossible just months ago. Silver, the forgotten metal, the one that gets dismissed as gold's poor cousin, has been showing signs of life that have veteran traders doing double takes. But here's what most people miss when they look at these price movements. They see numbers on a screen. They see percentages. What they don't see is the machinery behind those numbers, the massive structural shifts happening in the global financial system that are driving this move. Think about what money actually is for a moment. Not what we've been told it is, but what it fundamentally represents. For most of human history, money was something tangible, something you could hold, something that had intrinsic value because of its scarcity and the labor required to obtain it. Gold and silver weren't chosen as money by governments or central banks. They emerged naturally because they possessed the qualities that made them ideal for storing and transferring value across time and space. Then something changed. In a series of decisions made over the past century, we moved away from that system. We created a new kind of money, one backed not by physical assets, but by promises, by faith in institutions, by the full faith and credit of governments. And for a while, that system worked remarkably well. It enabled unprecedented economic growth, global trade, and financial innovation. But every system has its limits, and we're starting to see the cracks in this one. Before we go further, I want to share something with you. I've put together a comprehensive guide that breaks down exactly what's happening in the precious metals market and what it means for your financial future. It's the same information that thousands of American retirees are using right now to protect their hard-earned wealth. You'll find it in the description below, completely free, no strings attached, just real information that can help you make informed decisions about your financial security. Now, let's talk about what's actually happening in the gold market right now, because this is where things get interesting. Central banks around the world have been net buyers of gold for over a decade, but the pace has accelerated dramatically. We're not talking about small, incremental purchases. We're talking about hundreds of tons of physical gold being removed from the market and placed into sovereign vaults. China's central bank has been adding to its reserves month after month. The same with Russia, Turkey, India, and a growing list of nations that are quietly but systematically increasing their gold holdings. Why would they do this? These are sophisticated institutions with access to the best economic minds in the world. They can invest in anything: stocks, bonds, real estate, cryptocurrencies, you name it. Yet they're choosing to allocate significant portions of their reserves to an asset that pays no interest, generates no dividends, and just sits in a vault. The answer becomes clear when you understand what they're preparing for. The global monetary system is undergoing a transformation. The dollar's role as the world's reserve currency, a position it's held since the end of World War II, is being challenged in ways that would have been unthinkable a generation ago. Countries are conducting trade in their own currencies, bypassing the dollar entirely. The BRICS nations are exploring alternatives to dollar-based settlement systems. Even traditional U.S. allies are diversifying their reserve holdings, reducing their dependence on dollar-denominated assets. This isn't happening because these countries hate America or want to see the dollar fail. It's happening because they're looking at the same data you can look at. They're seeing debt levels that have exploded beyond anything in peacetime history. They're seeing central banks that have expanded their balance sheets by trillions of dollars. They're seeing political dysfunction that makes long-term fiscal responsibility seem like a fantasy. And they're making rational decisions to protect their national interests. Here's where gold comes into the picture. When you hold gold, you're holding an asset that exists outside the traditional financial system. It's not someone else's liability. It doesn't depend on a government's promise to pay. It can't be printed, inflated away, or defaulted on. In a world where trust in institutions is eroding, where the stability of the monetary system is increasingly questioned, gold represents something concrete, something real. But let's dig deeper into the mechanics of what's happening, because the surface-level story of central bank buying is just the beginning. The gold market operates on two levels: the physical market, where actual metal changes hands, and the paper market, where contracts and derivatives are traded. The paper market is massive, dwarfing the physical market by orders of magnitude. For every ounce of physical gold that exists, there are multiple claims on that gold in the form of futures contracts, ETFs, and other financial instruments. This system works fine as long as everyone plays along. As long as most people are content to own paper claims on gold rather than demanding physical delivery. But what happens when that changes? What happens when a significant number of holders decide they want the real thing? We've seen glimpses of this dynamic in recent years. Premiums for physical gold and silver coins have spiked. Delivery delays have stretched from days to weeks to months. Refineries have struggled to keep up with demand. The COMEX, the major exchange where gold and silver futures are traded, has seen its registered inventory, the gold that's actually available for delivery, decline significantly. At the same time, open interest, the number of contracts outstanding, has remained elevated. This creates a mathematical problem. If even a small percentage of contract holders demand physical delivery, there simply isn't enough gold to go around. The exchange would face a choice: default on contracts, force cash settlement, or somehow source massive amounts of physical gold at whatever price necessary. Think about what that means. The price you see quoted for gold, the spot price that everyone references, is largely determined by trading in this paper market. But if the paper market's credibility comes into question, if people start to doubt whether those paper claims are truly backed by physical metal, the entire pricing mechanism breaks down. The real price of gold, the price you'd have to pay to actually get your hands on physical metal, could diverge dramatically from the paper price. We've seen this happen before in other markets. When a financial instrument's backing is questioned, when people lose faith in the system's ability to deliver on its promises, prices can move in ways that seem irrational until you understand the underlying dynamics. The scramble for physical assets, the panic to convert paper claims into real things, can create price spikes that make previous highs look quaint. Now let's talk about silver, because if gold's story is compelling, silver's is absolutely explosive. Silver has always been gold's more volatile cousin. It's used in industry in ways that gold isn't. Electronics, solar panels, medical applications, water purification, the list goes on. Over half of all silver mined each year is consumed in industrial applications, meaning it's gone forever. It's not sitting in a vault somewhere waiting to come back to market. It's dispersed in tiny quantities across millions of products. At the same time, silver is also a monetary metal. It has the same properties that made gold valuable as money: scarcity, durability, divisibility, but silver is more accessible. An ounce of gold costs thousands of dollars. An ounce of silver costs dozens. For the average person looking to hold some precious metals, silver is often the entry point. This dual nature creates a unique dynamic. Industrial demand provides a floor, a baseline level of consumption that has to be met regardless of price. Monetary demand, investment demand, adds a layer on top that can surge during times of economic uncertainty. And here's the kicker. The silver market is much smaller than the gold market. It takes far less money flowing into silver to move the price significantly. Look at what happened during previous precious metals bull markets. In the late 70s, silver went from single digits to $50 an ounce. In 2011, it nearly hit 50 again. These weren't gradual moves. They were explosive rallies driven by a combination of monetary fear and supply constraints. And each time, the vast majority of people missed it. They heard about it after the fact, when prices had already peaked and started to decline. The setup today is arguably more compelling than it was in either of those previous periods. Industrial demand for silver is at all-time highs and growing. The push for green energy, for electric vehicles, for expanded electronics manufacturing, all of this requires silver. At the same time, silver mining production has been relatively flat. The easy deposits have been mined. New discoveries are rare. Most silver comes as a byproduct of mining other metals. which means silver supply is largely dependent on the economics of copper, lead, and zinc mining. On the monetary side, we're seeing renewed interest in silver as a store of value. Retail investors are buying physical coins and bars at levels that have surprised even the mints producing them. The US Mint, the Royal Canadian Mint, the Perth Mint, they've all reported surges in demand that have strained their production capacity. This is real demand from real people who want to hold physical metal. But here's what keeps me up at night. The same dynamics we discussed with gold, the disconnect between paper and physical markets, exists in silver, but in a more extreme form. The silver market is smaller, less liquid, and more prone to squeezes. When industrial users need silver, they need it. They can't wait for prices to come down. They have production schedules to meet, contracts to fulfill. If physical silver becomes scarce, if the just-in-time supply chains that the modern economy depends on start to break down, the scramble for available metal could be intense. We've already seen hints of this. There have been periods where premiums for physical silver coins were running 30, 40, even 50% above the spot price. Think about that. The paper price says silver is worth one thing, but if you actually want to buy physical silver, you're paying dramatically more. That's not a functioning market. That's a market under stress, a market where the official price and the real price have diverged. Now, I know what some of you are thinking. This sounds like doom and gloom, like I'm trying to scare you into making irrational decisions. But here's the thing. I'm not telling you the financial system is going to collapse tomorrow. I'm not saying you should sell everything and buy gold and silver. What I am saying is that the smart money, the people who have access to information and resources that most of us don't, are taking steps to protect themselves. And maybe, just maybe, we should be paying attention to what they're doing rather than what they're saying. Let me tell you a story that illustrates this point. Back in the early 2000s, there was a hedge fund manager who started noticing something odd in the housing market. Mortgage standards were deteriorating. People with no income, no job, no assets were getting approved for massive loans. The whole system seemed to be built on the assumption that housing prices would keep rising forever. This manager started digging deeper, looking at the actual mortgages backing these securities that Wall Street was selling, and what he found terrified him. He tried to warn people. He tried to explain that the emperor had no clothes, that these mortgage-backed securities were garbage wrapped in a bow. And you know what happened? People laughed at him, called him crazy, said he didn't understand how the modern financial system worked. Right up until the moment it all came crashing down in 2008. The people who listened to him, who understood what he was seeing, they protected themselves. Some even profited. The people who dismissed him lost fortunes. I'm not comparing myself to that hedge fund manager, but I am saying that sometimes the consensus is wrong. Sometimes the official narrative, the one that everyone accepts without question, is missing something crucial. And the people who are willing to look at the data, to think independently, to prepare for scenarios that seem unlikely but aren't impossible, those are the people who survive and thrive when things change. Speaking of preparation, if you're sitting on retirement savings, if you have $100,000 or more in IRAs or 401ks, you need to understand something. Those accounts are invested in a system that assumes stability. That assumes the dollar will maintain its purchasing power. That assumes the stock and bond markets will continue to function normally. But what if those assumptions are wrong? What if we're entering a period where the old rules don't apply? That's why I put together a comprehensive guide on gold IRAs. It's not about abandoning your retirement accounts. It's about diversification, about having a portion of your wealth in assets that aren't correlated with the stock market, that aren't dependent on the dollar maintaining its value. The guide covers everything: how gold IRAs work, the tax implications, how to get physical gold into your retirement account without penalties, all of it. You'll find it in the description. And here's the thing, this isn't some sales pitch. It's education. Information you can use to make your own informed decisions about your financial future. Because at the end of the day, that's what this is about: making informed decisions, understanding the landscape, seeing the forces that are shaping our financial future, and positioning yourself accordingly. The people who do well in times of change aren't the ones with the most money or the best connections. They're the ones who see what's coming and adapt. Let's talk about some historical parallels, because history doesn't repeat, but it often rhymes. In 1971, President Nixon closed the gold window, ending the dollar's convertibility to gold. At the time, gold was $35 an ounce. Over the next decade, it rose to over $800. That's not a typo. A 20-fold increase in less than 10 years. The people who understood what that policy change meant, who recognized that untethering the dollar from gold would lead to inflation and currency debasement, they positioned themselves accordingly. Or look at 2008, the financial crisis that caught most people by surprise. But it didn't catch everyone by surprise. There were people who saw the housing bubble, who understood that the derivatives built on top of subprime mortgages were a house of cards. They positioned themselves to profit from the collapse, not because they were evil or wanted people to suffer, but because they understood the math, the incentives, the structural problems that made a crisis inevitable. We're in a similar moment now. The structural problems in our financial system, the debt levels, the unfunded liabilities, the political gridlock that prevents meaningful reform, these aren't secrets. They're public knowledge. Anyone can look at the numbers, but most people don't. They trust that someone else is handling it, that the experts have it under control. And maybe they do. Maybe everything will be fine. But what if it's not? Gold and silver aren't just investments. They're insurance. They're a hedge against scenarios that we hope won't happen but need to prepare for anyway. You insure your house not because you expect it to burn down, but because the cost of being wrong is too high. The same logic applies to your financial security. The cost of holding some precious metals, of having a portion of your wealth in assets that exist outside the traditional financial system, is relatively low. The cost of not having that protection if things go wrong could be catastrophic. Let me give you some specific numbers to think about. The total value of all the gold ever mined in human history is somewhere around $12 trillion. That sounds like a lot until you compare it to other asset classes. The global stock market is worth over 100 trillion. The bond market is even larger. Real estate dwarfs both. Gold represents a tiny fraction of global wealth. If even a small percentage of the money in stocks, bonds, or real estate decided to move into gold, the price impact would be enormous. And here's the thing, that movement has already started. We're seeing it in the central bank purchases. We're seeing it in the retail demand for coins and bars. We're seeing it in the inflows into gold ETFs. The smart money is already positioning. The question is whether you're going to wait until everyone else figures it out, until gold is making headlines and prices have already moved significantly, or whether you're going to act while there's still time. Silver's numbers are even more striking. The entire above-ground supply of silver available for investment is estimated at around 2 billion ounces. At current prices, that's roughly $60 billion worth of silver. For context, that's less than the market cap of many individual tech companies. It's a rounding error in the global financial system. If institutional money decided to allocate even a fraction of a percent to physical silver, there simply isn't enough to go around. This is why the paper market exists. It allows for price discovery and trading without the constraints of physical supply. But it also creates vulnerability. When the paper market and the physical market diverge, when people lose faith in the paper claims and demand physical delivery, that's when things get interesting. And by interesting, I mean potentially explosive. We're already seeing signs of stress. The premiums on physical silver, the delivery delays, the declining inventories at the COMEX. These aren't normal market conditions. They're symptoms of a market that's being stretched, where demand is outpacing supply in ways that the existing infrastructure wasn't designed to handle. Think about the implications for a moment. If you're an industrial user of silver, if you need it for your manufacturing process, and you can't get it, what do? You pay whatever it takes. You lock in long-term supply contracts at elevated prices. You build inventory as a buffer against future shortages. All of these actions put upward pressure on prices, which attracts more investment demand, which puts more pressure on supply, which drives prices higher still. It's a feedback loop, and once it gets going, it can be hard to stop. The same dynamic applies to gold, though perhaps less dramatically because gold doesn't have the same industrial demand component. But gold has something else. It has 5,000 years of history as money. It has cultural and psychological significance that goes beyond mere economics. When people lose faith in their currency, when they worry about the stability of their financial system, they turn to gold. It's instinctive. It's been programmed into human behavior over millennia. And right now, there are a lot of reasons for people to be worried. Inflation, even though it's come down from its peaks, is still running above the levels that central banks claim to target. Real wages, adjusted for inflation, have been stagnant or declining for many workers. The cost of housing, healthcare, education, all the things that matter for quality of life, have been rising faster than official inflation numbers suggest. Meanwhile, the solutions being proposed are more of the same: more government spending, more central bank intervention, more debt. The idea that we can solve problems created by too much debt by taking on even more debt is, frankly, insane. But that's the path we're on, and at some point the bill comes due. When that happens, when the consequences of decades of monetary and fiscal excess finally manifest, what do you think happens to the value of paper currencies? What happens to assets that are denominated in those currencies? History gives us a pretty clear answer. The currencies lose purchasing power. The assets denominated in those currencies lose real value. And the things that can't be printed, that can't be inflated away, those things preserve and often increase their purchasing power. This isn't theory. This is what happened in Weimar Germany, in Zimbabwe, in Venezuela, in Argentina, in every country that has tried to print its way to prosperity. The specifics differ, but the pattern is the same. First comes the denial, the insistence that this time is different, that modern monetary theory, or whatever the justification of the day is, will prevent the historical pattern from repeating. Then comes the acceleration, the realization that the policies aren't working, that the problems are getting worse, that more extreme measures are needed. And finally comes the crisis, the moment when faith in the currency breaks, when people scramble to convert their paper wealth into real assets, when the official price and the real price diverge so dramatically that the system breaks down. I'm not saying we're there yet. I'm not saying the dollar is going to collapse next week or next month. What I am saying is that the trajectory we're on, the policies we're pursuing, the structural problems we're ignoring, they all point in a direction that should concern anyone who has worked hard to build wealth and wants to protect it. And here's the really important part. By the time it's obvious to everyone, by the time the crisis is undeniable and the mainstream media is covering it nonstop, it's too late. The prices have already moved. The physical metal is already scarce. The opportunity to protect yourself at reasonable prices has passed. The people who do well in these situations are the ones who act early, who position themselves before the crowd figures it out. That's why I'm talking about this now. Not because I have a crystal ball, not because I know exactly when or how things will unfold, but because the warning signs are there, the data is available, the historical precedents are clear, and the cost of preparing, of having some insurance in the form of precious metals, is relatively low compared to the potential cost of being caught unprepared. Let me address something that I know some of you are thinking. What about cryptocurrencies? Aren't they the new gold? Aren't they a better store of value for the digital age? Look, I'm not anti-crypto. I think blockchain technology is fascinating and will likely have important applications. But as a store of value, as a hedge against systemic financial risk, cryptocurrencies have some serious limitations. First, they're entirely dependent on technology infrastructure. If the power goes out, if the internet goes down, if there's a major cyber attack, your crypto is inaccessible. Gold and silver, on the other hand, are physical. They exist regardless of whether the grid is functioning. Second, cryptocurrencies are still relatively new. They haven't been tested through a real financial crisis. We don't know how they'll perform when the system is under serious stress. Gold and silver have been tested repeatedly over thousands of years. We know how they perform. Third, and this is crucial, governments can and do regulate cryptocurrencies. They can make it difficult or illegal to transact in them. They can shut down exchanges. They can track transactions. The idea that crypto is beyond government control is, I think, naive. Gold and silver, especially physical gold and silver that you hold yourself, are much harder for governments to control or confiscate. None of this means you shouldn't own crypto if you believe in it. But it does mean that crypto and precious metals serve different purposes and have different risk profiles. Diversification means holding multiple types of assets, not putting all your eggs in one basket, whether that basket is stocks, bonds, real estate, crypto, or precious metals. Now, let's talk about what you should actually do with this information. First, educate yourself. Don't take my word for anything. Look at the data. Read about monetary history. Understand how the financial system works and what the risks are. The more you know, the better decisions you'll make. Second, assess your own situation. How much of your wealth is tied up in dollar-denominated assets? How exposed are you to a decline in the dollar's purchasing power? How much insurance do you have in the form of assets that exist outside the traditional financial system? There's no one-size-fits-all answer. It depends on your age, your income, your risk tolerance, your financial goals.